My name is Kier. As it says, well, actually says I'm head of IP risk and structured solutions. We've actually made a couple of changes, so I now lead our value creation business, which includes our structured solutions offering, which is the most relevant from a private credit perspective, as we look at how we can help private credit either enhance existing capital structures through insurance-enhanced NAV loans, as well as actually bring new capital to bear for the benefit of the private credit industry. I think it's well known how big supporters insurers are on the investment side of their balance sheet. Our job is to try and mobilize the other side of their balance sheet, the liability side, to essentially act as a synthetic LP to encourage more investment into great managers such as we have here today. So I'll ask the panelists to introduce themselves, and then we'll look to have a relatively interactive session amongst the panelists as we assess accessing capital from a variety of different perspectives. Ravneet.
I'm Ravneet Mann. I'm a partner at Stride Ventures. Stride is a growth credit fund originated out of South Asia. We have presence in the GCC and in Europe and UK. We are primarily a firm that's very dedicated to and committed to, uplifting high growth companies in the tech space. We are sector and stage agnostic. Just taking a leaf out of what the Chancellor said in the previous session, that there is one of a 3-point agenda. I think point number 1 she mentioned was high growth, and that's literally where we sit at the intersection of high growth and technology, and that's really where the future is.
Good morning, I'm David Wilmot, one of the founder partners of Apera Asset Management. Apera is a lower mid-market private credit firm concentrating upon UK and the majority of Europe. And we were founded in 2016. We now have 5.1 billion euro under management across commingled funds and SMA structures in four countries. Looking forward to the discussion.
Yep. Good morning, Sanjay, Mistry, head of the alternative credit business at the Pension Protection Fund. The Pension Protection Fund, for those who don't know, is one of the largest asset owners in the UK. We have about 31 billion pounds, $45 billion, given most people talking dollar terms in credit. And that's kind of investing across public and private. The portfolios and the allocations that we have has a large steer to private credit. It's been one of the allocations we've been growing over the recent years. It started back in 2011. And that's been, I'll say, the last few years in particular, it's kind of seeing that scale up. We focus on both on the investment grade side as well as the sub-investment grade side. And it's one actually, Blair was talking about some of the other groups beforehand. Asset owners don't really have large allocations to private markets or alternatives. PPF is probably slightly different to the average, thankfully. Around 50% of our growth portfolio, over 50% is actually in alternatives, 50% in private markets. And a large steer of that actually has a credit flavour associated with it.
Great. Maybe Sanjay, just staying with you. Obviously, PPF allocates directly into direct investments, but also you support other managers as well. Mm-hmm. So maybe a perspective from an LP, what are you seeing out there? What are managers having to do to differentiate themselves to get access to PPF's capital?
A lot of things. It's very difficult. I think it's a very challenging environment. 2025 has seen, obviously, we're coming off 3, 4, 5 years of significant growth. The fact that we have a private credit forum on the summit of the BVCA is an example of that. It used to be one of the adjunctions in the summit agenda. Now it's one of the mainstreams. Hopefully it'll stay and continue. I do agree that credit is around in a long way. It supports all transactions in a variety of forms. Sometimes it's not something that's seen on the capital in the capital structure, but it's in the behind the scenes in terms of risk profiling and what it's able to do. And that's allowed the GP community to kind of really expand. It's kind of and move away from what Rachel's Reed was saying was like the vanilla, right? The plain vanilla parts of investing, and credit's done that as well. The private credit space has given so much more. That's made our life as an asset owner quite challenging. We're still sort of thinly resourced. Is probably the best way to describe it relative to the opportunity set that we have. We're trying to work with GPs when we can, but GPs are becoming more and more innovative. As the industry has grown and more opportunities come through, we're trying to find different ways to partner with those relationships. We recognise that our resources don't allow us to do everything we want to do. We do some direct deals. We'll do some, most of what we have actually within our accounts is actually through separate structures where we kind of work with our GP relationships to kind of direct flow to loans and assets and risk profiles we're comfortable with. but we'll also invest in commingled funds. So we have the whole gambit across the platform, but I think it is very challenging at this point. More and more GPs, we've seen consolidation taking place, which kind of helps and doesn't help because obviously that creates its own challenges. But what it does do is gives us scale and the ability to kind of partner with those relationships in a bigger form. Our portfolios are global, and as a global portfolio, we have a big allocation to the UK. UK actually is the single largest country exposure we have in the balance sheet. So again, supporting the theme is like the opportunity set. The UK is a great place to be. There's a lot of deals that can be done, and we've seen the equity markets, public equity markets, really struggle in the UK for the last 20, 30 years that I've been doing this, and the inverse has happened in the private space. All the opportunities that we've been seeing previously are still here. All the the growth ideas, all the innovators, all the value that exists. And in the private credit space, I'm taking that whenever I can. It certainly makes my life easier to think about a UK transaction versus a non-UK transaction, and thinking about the hedging risk that goes with non-sterling exposure as well, which I have in the portfolio. But I'm not going to say no to a non-UK deal if there's a value that's been done. It needs to hold its place in the portfolio, and that's what drives my ultimate bar.
Maybe David, the reverse perspective. You guys have had one hell of a first 9 months of the year, pretty busy at Apera, particularly with respect to Fund 3, surpassing the hard cap. It's a few years since you last raised. How different was the environment this time around? How did you feel? What did you have to do differently to really attract the capital to have that success?
Yeah, I guess the contrast is between a fundraising period of 2020 to 22 for the previous fund and through till April of this year, another 2-year period or so in fundraising. The third fund, which, as we kindly said, did go through the hard cap. Thanks to our investors for supporting us. And I think what became interesting, if you look at the the profile of investors percentage-wise, that's investor classes. It's stayed pretty static, but in actual volume terms, one of the things we noticed was sovereign wealth funds actually, in terms of cash, was probably 5 times what was in the previous fund, and I think, and within that, it was 11 countries as opposed to 9 countries for the second fund. So one of the things that did happen was that Asia Pac became more of a factor, Korea in particular. And I think there were 2 reasons underlying that particular dynamic. One was that every day, every fund that you raise, the general sophistication level of the people you're talking to raises all the time. And I've been doing this long enough to see that progression over a long period of time. When you're talking about your particular strategy, our strategy very, very much focused on low mid-market, downside protection, very stable risk return. That's not just like noise. It's something that people understand, have research before you meet them, and actually understand what you're talking about. So that was one thing that really did pay dividends. And I think the other was a move away from some of the traditional household name firms. We were 2016. We were nothing, just 2 people and an idea in somebody's kitchen. And so what changed then was to say, okay, as a big investor, I'll think about diversifying away from those household names and into something that gives me something else, and access to lower mid-market as opposed to upper mid-market, and what that brings in terms of what we would say a stable risk return and very good downside risk protections. And that was something that really did develop. We saw quite clearly during the course of the fundraising, and also probably given them a different deployment opportunity as well, given the consistency of deployment that we've been able to deliver. So I would say broader interest definitely in the asset class. That's growing all the time. There are always challenges that you face. I mean, pretty early on we faced the denominator effect, and that was something that meant that the overall fundraising period was a little bit longer than really we would have liked, quite candidly. But it's, I would say, overall a very positive report card in terms of how we see the market and the positioning of the market, the appetite of investors.
Great. Maybe just building on the comment you mentioned around household names. Ravneet, obviously you wear a number of different hats, but the current fundraise you have ongoing, as an established manager outside of the UK coming to the UK, you're a household name, not necessarily from a UK perspective. Maybe just talk through that dynamic in terms of how you found raising in the UK environment, and then I'll come to some questions. I'd love to get your perspective on kind of how you see the work you do in the market from a growth perspective, but maybe start on the fundraise.
Sure. So addressing the fundraise part first, right? Everywhere else, we've been backed by the sovereigns, whether it's in Saudi or India. It's been a great journey. There's a huge institutional focus, and I think from that perspective, looking at the UK, it's been a bit different for us when we've looked at engaging with the likes of the British Business Bank, et cetera, where there's a clear focus on getting that match funding as well, and then looking out to the private market, and then just touching on the pensions. I think UK, and this is more to Sanjay here on the stage, but UK has, I think, one of the highest pension and insurance savings per capita in the world. It's 7 times the global average. But if I were to look at the amount that's going into alternatives, and specifically within that to venture, and then if I were to drill down further into growth credit, I would say it's minuscule. It's like 0.007%. That's like 1 in every 14,000 pounds compared to probably 1 in every $100 to $200 in the US. So from that perspective, yes, it's been a very different fundraising environment for us when we're looking at raising locally. The expectation, of course, and I was speaking to some of my peers, most of the capital is raised outside of the UK for deployment in the region. So the fund that we've launched here, it's our 6th fund. It's primarily going to be investing in the UK. I would have expected a natural proclivity for UK investors and pensions to, come in. I think there's a lot of education and awareness that we're trying to build about the asset class. The Chancellor was talking of high growth. We come in at the lower end of the lower mid-market when, David's talking of the lower mid-market. And that's really where a lot of capital needs to be going to get those companies. I was having an interesting conversation with a lady this morning. She's on the boards of one of the pensions, and she was like, some of the local pensions start supporting, or, they're working with development banks in the regions, and there's an escalator that these, companies are getting onto, and then it just ends. So I think that's where players like us really come in. We've been able to do that very successfully with over 180 companies globally. The expectation is that we'll be able to do it here. The idea is, can we try to do it in the same time frame? We've done it elsewhere. I wouldn't want to say that we have the luxury of 2 to 3 years to fundraise. That's not been our repertoire in the past in terms of how we've looked at fundraise. So yeah, learning along the way.
How, maybe speaking of learning along the way, you guys have already warehoused a number of transactions. While venture debt has grown in the UK and Europe, it's still a relatively new tool that entrepreneurs consider. You kind of talk about that, kind of that scale-up challenge that many have. Some of that's a lack of access, a lack of alternatives. At the same time, I'm told the venture debt market is pretty tight right now. So how have you found those first few transactions? What have you had to do to get transactions away? And maybe what are some of the questions that your borrowers are asking of you guys?
I think getting the transactions has been the easy part, purely because we've been a fairly global player. So you're co-investing with some of the largest global sponsors, in the world. So that, in fact, it's been, I would say the other way around. We viewed it very differently as an opportunity as opposed to a tight market, because if you look at, growth credit here, there has been a fairly localized, regionalized approach in terms of how it's being addressed. We're trying to change that. We're trying to bring in a far integrative global perspective, which will take time. But I think that's the value add we want to bring to this ecosystem.
David, maybe I'll turn to you. They say comparison is the root of all evil, but I think it's important for us to set the UK in context relative to globally. In addition to the fundraise, you guys have a transaction that I know is subject to final close, and I won't ask you too many specifics. But when Franklin Templeton look at Apera, maybe just speak generally around what do they see in the UK market, and what is it that attracts that outside kind of US interest in what we're doing?
So you really are asking me about Franklin
I mean,
Templeton.
with that as the context, a general overview would be helpful.
It is still subject to regulatory approval, so I can't really say too much about that. But the interest in it's lower mid-market, and they wanted to get into lower mid-market in Europe, and it came about that way, really, as an opportunity which they felt was one that very much corresponds with our own view that that there was really a systemic change that happened when the banks started to pull back from this part of the market, and firms like the one I used to work for were getting bigger and bigger and moving up to larger transactions, larger fundraising. So there was a gap that we felt was long-term that needed to be filled, not just in the UK, but also in Europe. When you're a European manager like we are, then the UK is a big part of the overall portfolio that we are looking to put in place. So even though we're a European manager, we're based in London, that's bringing a lot of capital into the UK to invest into UK businesses. And part of the, I think the service that private credit is providing is not just day one investment, but day one, we will, oh, there it goes. We will have committed acquisition facilities to support acquisitions, to support capital investment. So it's organic as well as inorganic growth that's being supported. And that's I think, a continuing feature of where the UK benefits from pan-European and in some cases even global investors in London, raising capital. I'm not entirely sure I've completely answered your question, but I've done my best with several microphones.
A couple of interruptions along the way. Sanjay, maybe just coming to you, the Chancellor touched on kind of the stability of the UK, the trade positive outlook, reduction in quangos was another thing she cited. What more do you think can be done to support? Is there anything kind of you and your team are looking out for in the budget that might help? Or just generally regulatory intervention?
Yeah, I say, look, our focus tends to be on sort of ensuring that any opportunity that we are sort of faced with and presented with is one that can add value on a risk-adjusted basis within the portfolio. It is quite simple. Obviously, the implementation of that is extremely complicated and it's quite tricky. So if you have an ecosystem here in the UK, which is going to be supportive, very much in line with what Michael was saying. We can give a 5 to 7 year sort of view, a longer term stability, and give us confidence that actually the credits that we are backing are actually sort of operating in an environment which is going to be conducive to us providing them that loan. I welcome that. One of the challenges we've had is obviously when we go outside the UK, what are the other ecosystems out there, and how do those sort of opportunities, how do those markets kind of support a credit investment? And they exist. Obviously, you have jurisdictions which are very, creditor friendly, and others which are less so. That's repriced appropriately, and then you take a view as to whether you want to continue to support that situation or not. As we've kind of looked at sort of higher risk areas, I guess we've kind of shifted away to more asset backed and more sort of securitized sort of situations. So sometimes you get sort of structured ways of gaining a bit more comfort in an environment. So maybe you want ownership structures around some of the equity or the underlying collateral that's going to be backing your loans, and you give comfort to say, well, actually, the jurisdictional risk is somewhat changed now. It's already sitting on my balance sheet, and therefore that capital sits with me, and I don't have to sort of work through that on a downside scenario. Other times you kind of look for ways to say, well, and that's what I'm trying to look for in the UK. In the UK, we don't need that in the same sort of way. Obviously, we have that sort of visibility, and as much as the government's able to continue to support, I think that gives us confidence to say, well, we'll continue to back. Like I said, we have a big bias to the UK already in the portfolio, and it makes a lot of sense for homegrown capital to be backing the UK. I've certainly been doing that for the 30 years I've been doing this, and I don't see why that needs to change. I think what we are seeing, and maybe comes back to the point Ravneet made, is from us, from the asset owner side, that the environment has evolved over that window. Risk profile has changed across other asset owners, I'd say. And maybe there's a big pool of capital, but I don't think all that capital takes risk to the same extent. I think not all of them have got the resources or that we have at the PPF, thankfully, and that gives us a little bit of competitive advantage. so that we can assess situations and work through those opportunities. And it's challenging, right? If you're working on a direct deal and you have a 6 to 8 week window, sometimes you want to work through that. It's difficult to do. You have to get all our teams. We have a whole in-house team of experts who can support me on my deal when I'm actually working through something, that can say, well, actually, look, if I need some advice in particular areas, I've got internal resources I can turn to. I'd say the average asset owner in the UK doesn't have that. That's why it's been mainly outsourced, and other institutions end up doing that on their behalf. And when you do that, the opportunity set becomes global, doesn't stay local. So it's a case of moving things around.
You touched on risk profile there just changing. Maybe a perspective from each of you just on performance of kind of UK private credit relative internationally. We've obviously had COVID, we've had Ukraine war. How whether it's directly from your portfolio, just generally, how does the UK market performing relative to international peers?
I think look at it two ways. Firstly, Sanjay was mentioning jurisdiction risk. From that perspective, I think UK, and perceptionally as well, I think UK has addressed that quite positively, and I'm seeing that in my effort at the fundraise. And it's definitely a huge advantage when I'm looking at other funds in other geographies as well. And if you look at it statistically in terms of what the data is really showing, and if you look at the 5-year returns, and you look at the loss rates in the last 5 years, this industry is sub 1%. In the last 5 years. I'm not extracting it to 10 years where, but even then the departure is not so much, right? I can speak for, from our perspective, we've done 108, we've got 108 portfolio companies. We've done more than 600 transactions. I can count the losses we've experienced on my fingertips, and it's minuscule. It's about how you appreciate and understand, and you have a very specialized, nuanced way of underwriting this asset class, which requires you to go in depth and understand from the companies, which is why a plain vanilla late stage private credit kind of approach would not work in our domain. It has to be very bespoke, structured solutions that you're making for these companies, which you're marrying to their needs and cash flows, and figuring out how you can structure the transaction in a way to enable them, for it to not go into, a stressful scenario later, and serving the purpose that it does for the company as well as for the LPs at this end. So from a risk-adjusted return profile perspective, I would say it's a fabulous asset class. I'm sounding a bit salesy here. Sorry about that, but I genuinely believe so.
Perfect. Well, maybe that's not a bad place to finish. I think we've only got about 30 seconds left. So thank you very much for your contributions today, and thanks everyone for listening.